It almost doesn't matter what the Fed does from here unless they start cutting rates dramatically. We're going to see monetary conditions tighten going forward, which will slow the economy, yada, yada. We're still going to pay the price for higher interest rates for at least another year, and that's going to break a lot of things.
This is Kaiser Johnson with Liberty in Finance, and this is the Miles Franklin Weekly Special from May 9th through 16th, 2023, while supplies last. This week, we are excited to feature the 2023 Australian Silver Kangaroo at just $4.85 over spot. The 2023 Silver Kangaroo from Australia are renowned for their 4/9 fine purity, as well as their recognizability and design. Like many other coins, they come 25 to a tube. However, unlike others, the Australian Monster Box is just 250 coins, making it the most affordable Monster Box available, especially with a premium of just $4.85 over spot per ounce. And finally, Silver Kangaroos are IRA eligible. If you'd like to learn more about a precious metals IRA, an IRA holding assets in a private depository rather than a bank or brokerage, call us, and we'll be happy to help you in that process. To order this special or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today is our good friend John Rubino from rubino.substack.com, formerly the founder of dollarcollapse.com. John, thank you so much for joining us today.
Hey Elijah, good to talk to you again.
Well, you recently put out an article here. I wanted to get to that. It's really the failure of the philosopher king. So essentially you go over how really back in the 60s, the U.S. started trusting, PhDs and all these experts. And really it's been a failure across the board in many different areas. And you mentioned in the article at the end that either it's essentially incompetence, or there's, they're brilliant soldiers, you say, in the war for super rich supremacy. What has happened is the rich have gotten richer and the poor have gotten poorer. So it's really enriched the elite class. Can you talk about kind of the failure, as you mentioned, of the philosopher king?
Yeah, I think the title was the failure of experts, because basically we decided to depend on experts. The backstory is that in Plato's Republic, a book written 3,000 or so years ago, they have a political debate about what is the best form of government. And they conclude that the best form of government is an absolute dictatorship with the very best, very wisest person in charge. And, you put them in charge and they'll do what is right, and society will be just, and all the other good things you hope a good society will be. And in the 1960s in the US, especially, but really around the world, we embraced a variation of that, which is the best and the brightest. You bring in your smartest people, put them in charge of a problem, and they will handle it. So, we started with the Vietnam War, where that was actually the term for the guys in charge of the Vietnam War was the best and the brightest. And then from there, we ended up basically just expanding that concept to everything. We went off the gold standard, which was a kind of a mechanistic way to run monetary policy. And we adopted fiat currencies around the world, which basically run on the PhD standard. You take some high-powered economist and you put them in charge of the money supply. And because they're so smart and they can understand the economy, they manage the money supply and interest rates better than would some mechanistic arbitrary thing like the gold standard. And now it's basically spread to everything. Every aspect of our society is run by a handful of people who got degrees at the best schools, and they've been very good in their fields up till then. And we expect them, because they're the smartest among us, to manage things in a successful way. But in fact, the experts have failed miserably at everything. Monetary policy is a catastrophe. We're a wildly over-indebted global financial system now that is on the verge of collapsing and forcing us into some kind of a monetary reset, which will probably take us back to something mechanistic like a commodity-based system. Our foreign policy, which is run by, Kremlin experts and Middle East experts, is a nightmare. The U.S. stomps around the world, invading people randomly and cutting alliances with people who then become our enemies as soon as we arm them. And it goes on and on. And basically what we're doing is creating enemies everywhere in the world on an exponential basis. We're in bigger trouble globally than we've ever been, probably. And the reason for that is that we've wildly, catastrophically mismanaged our foreign policy. So take any sector of American society in particular, look at who's in charge. And it's all the same people. It's the guys with Yale and Harvard degrees who know the right people and get nominated for their positions because they know the right people, and they're making a mess of everything. So I don't think it's an exaggeration to say that the whole concept of expert is falling into disrepute. And by the way, the reason I wrote that post was that there's a bit of an argument going on my Substack's comment section over whether people have gotten stupider in the last 7 years. And that is basically when Trump got elected, and then when everybody or most of the country decided maybe they don't want to vaccinate their kids after all with these experimental vaccines. Well, that looks like a descent into stupidity for a lot of people. But what it actually is people learning from their experiences to not trust expert opinion anymore. Public health is just a total mess in the U.S., where we used to trust the CDC and the National Institutes for Health and our doctor. And now, in large part, we don't anymore because they messed up the whole pandemic response in such an outrageous way. So my take was that we're actually, we're not getting dumber. We're actually becoming more experienced, and we're behaving accordingly. So we're learning as we go. So in that sense, we're becoming wiser, if not smarter in terms of IQ. But where it goes from here is anybody's guess, because the experts haven't given up yet. So they're still trying to run things, and they're still messing everything up. So I think we've got more of a learning experience ahead of us.
Now, you mentioned obviously the mess that we're seeing in monetary policy right now. Raising rates has obviously caused a lot of issues in the banking system. We just got the CPI print out today at 4.9%, so the lowest we've seen in 2 years. Obviously, these are the official numbers, but that's what the Fed goes on. What do you anticipate the Fed doing from here, and how is it going to impact the financial system, the banks that continue to seem to have issues and collapse?
Well, that 4.9% CPI read was met with relief, because it means inflation is trending down. And the assumption is that this is going to give the Fed cover to stop raising interest rates. And then we'll have a massive relief rally, because we've transitioned from tightening to at least neutral and maybe even loose money, and that's massively mistaken. Because what will happen when the Fed stops raising interest rates, and I agree, they will probably stop raising sometime this year. But what will happen then is that monetary conditions will continue to tighten, maybe dramatically in some cases, because so much debt was taken on over the past decade or so at extremely low interest rates, and a lot of that debt has to roll over. So when it rolls over from, say, 1% loan bumping up to a 4% loan, let's say, that's a big jump in interest costs for whoever's rolling that debt over, which means their personal or corporate or government monetary conditions are tightening dramatically. Meanwhile, you've got consumer debt, especially credit card debt, soaring. We're almost up to $1 trillion in credit card debt in the U.S., which basically means people are, they're not buying big cars and exotic vacations with plastic. What they're doing is they're putting day-to-day expenses on plastic, which means they can't cover gas, food, and housing from what they're earning with their multiple crappy jobs. So they're going to have to, going forward, carry balances on their credit cards, which means they're going to be paying 20% or more on those balances, which means that those balances are going to continue to increase, and so on, which means their monetary conditions are tightening dramatically. So what we're seeing is it almost doesn't matter what the Fed does from here unless they start cutting rates dramatically. We're going to see monetary conditions tighten going forward, which will slow the economy, yada, yada. We're still going to pay the price for higher interest rates for at least another year, and that's going to break a lot of things. I'll continue with this thread here. I'm running a little bit long, but because one of the things that flows from that is that different segments of the economy are on the verge of blowing up, like commercial real estate. Money that was borrowed to put up, say, office buildings now has to roll over. But if it's going to roll over at a much higher interest rate, that makes those office buildings a lot less valuable, a lot less profitable. Somebody's going to have to eat that resulting loss. Maybe it's a pension fund, maybe it's an insurance company, maybe it's a local or regional bank, but whoever it is, they're going to tighten their lending standards, which is a tightening of monetary policy. So I think one of the things that flows from this is that the home builders are excellent short candidates right now. They're trading at close to 12-month highs, on the assumption that the housing market is going to get better as soon as the Fed stops tightening. But with mortgage rates at, what are they now, 6.5%, give or take, very few people can pay today's prices for today's houses if they have to borrow money at that rate. So I think the housing market is going to be frozen for quite a while. And that means home builders aren't going to do nearly as well as the market seems to think they are. So I'm working on another post in my Substack about how to short the home builders. And I think that in the year ahead, or maybe the next 2 years, they're going to be excellent shorts. They're going to be stocks that go down by half, which means put options on them will go up dramatically. And I think there's money to be made by shorting that sector starting right now.
We're seeing mainly the bond market, the collapse in the bond market causing a lot of issues with regional banks here. How do you see the collapse of the housing market impacting regional banks?
Well, not a collapse in the housing market, but a frozen housing market. And I think the collapse is probably going to come from commercial real estate. Regional and local banks, their business is basically to take in money from depositors and then lend that money out at a higher rate to commercial real estate or mortgages or personal loans or local business loans. Well, if commercial real estate goes into a tailspin here, and a lot of big buildings are sold for half of the original price, and that embedded loss has to be taken by somebody. If it's taken by the local and regional banks, then they've got to tighten their standards for future loans dramatically, and that's already happening. Banks are tightening their lending standards. And if that happens, then the business model of these banks no longer works. And the losses that have to be reported on the ongoing decline in commercial real estate values will spook depositors who pull their money out and go to money market funds or treasury funds or something like that. And then you'll see a lot more banks fail. So I think the banking crisis, which we're already in, we're already in the biggest banking crisis in terms of deposits at risk in U.S. history. We've seen more big banks fail than ever before. So the government is going to have to step in and bail out more and more local and regional banks as time goes on. And we can only guess at what that does. Does that spook the people who are depositors in the other state or local and regional banks? And did they pull their money out? And does the whole system collapse? Or do people look at the amount of money that it's going to take to bail out all these banks and focus on what that does to the dollar? And we'll see U.S. interest rates go up and the dollar's exchange rate, or at least the dollar's purchasing power, go down. We can't know for sure how this plays out, but either way, it's bad. And either way, it's kind of baked into the cake, because if money gets tighter from here, which it is going to, then these problems are just going to expand. There's nothing on the horizon that fixes, for instance, office buildings getting less valuable or apartment buildings having lower than expected occupancy rates and therefore becoming less valuable. Stuff like that is going to happen. So the only question is, how does it impact the financial system? And there's lots of different ways, all of them bad. and all of them leading to some kind of a short strategy. So I think that instead of freaking out over this, we should be looking at how we make money. And one way to make money is to find the things that are going to be most impacted by tightening money and bet against them. So I think that's an interesting play going forward, and it's one we should be focusing on.
Now, did you want to expand on that, kind of some short opportunities that you're looking at? Obviously, understanding that we can't give financial advice.
Yeah. And yeah, don't take this as financial advice. I am not a financial advisor, but I do explore possibilities on in my Substack. And one possibility is responding to tightening money by shorting companies in the industries that require easy money. Now, it's too late to short the banks, right? Their stocks have all tanked. It's too late to short a lot of the companies in commercial real estate because they've already seen their troubles be aired publicly, and their stocks are down. But the home builders, who basically are in the same industry and require easy money to really thrive, are up in the last year. So they become maybe the next domino to fall, let's say, or at least a reasonable short candidate, just because they're at a 12-month high in a market where conditions are still tightening. And it's very hard for virtually anybody to afford houses at today's prices. I think home affordability is the worst it's ever been. And if it's not, it's really close to what it hit in, say, 2007. And that means that very few people can buy houses today, which means that very few people are going to be contracting with home builders to put up their dream house right now because the money that they would have to borrow to do that is too expensive. So you kind of have to have cash to make something like that happen. And there aren't that many people who have cash other than the people who have just got done selling, say, a California house or something like that. They're out there and they're out there buying things, but they aren't the majority of the market. And if you're, for instance, a millennial working two jobs to make $40,000 a year, you're not going to be buying a $500,000 house, which is kind of what you have to pay for houses in a lot of markets. So the housing market is going to be disappointing, and that means the companies that are working in that industry are also liable to be disappointments. So that's a thesis. That's a thing that might work out going forward. And it's a thing that I'm going to spend the rest of the day after we get off here sketching out and trying to expand on for a post.
Now, I did want to ask you kind of how this is going to impact we talked briefly about how this is going to impact the regional banks. There's a lot of concern out there with respect to the regional banking sector right now, as we're seeing a few banks collapse here, pretty big actually, regional banks. But your perspective on that, and for those holding money in regional banks right now, what is your insight on that? Do you think this sector is going to be safe, bailed out if more regional banks collapse, or would you say possibly pulling money out of those banks would be a good idea? Well,
let's look what happened with Silicon Valley Bank, because that's actually kind of a funny example. They, there's a FDIC insurance limit of $250,000 for a bank account. In other words, the government will cover you if you have less than $250,000 in a bank if that bank goes bust. Well, Silicon Valley Bank had depositors that were putting in hundreds of millions of dollars, in a couple of cases $1 billion, without any regard for what happens if the bank gets into trouble. And the bank did get into trouble. Those guys, and a lot of them were, for instance, big Chinese entities. A lot of the others were venture capitalists, and a lot of the rest were Silicon Valley startup companies with their payroll money in that bank. So they were in serious trouble. And if we were going to play by the rules, if we were going to say, okay, well, we're going to make everybody who's $250,000 or less whole, and everybody else who didn't consider that their insurance didn't cover these accounts, are just going to have to bite the bullet and take the loss. Well, we didn't do that. We bailed out everybody. We basically just said, okay, everybody's covered. We're going to raise the limit on FDIC insurance to whatever, it can be $1 billion. And I think they kind of have to do that. They've set that precedent. So if some other bank in, say, Tulsa or Indianapolis goes bust, they're not going to let the local economy be crushed because they enforce the $250,000 FDIC insurance limit on those banks when they didn't do it on Silicon Valley Bank. So I think the government has basically obligated itself to bail out all the banks under any circumstances. And because of that, if you have money in one of those banks, you should, just in case, you should still keep your account below $250,000. But you're probably not at extreme risk of not getting your money back. I think the government kind of has to make you whole. Now, the risk is that, as I said before, people watching this process get nervous about the dollar, and they don't want to hold dollars anymore, and so the value of the dollar goes down. So you might get your account back in whole, in total, but the dollars you get back will be less than the dollars you put into the account. And that's a fairly real risk in this kind of world, because we're seeing how fast things happen, how markets break or spike or whatever. So you could easily see a run on the dollar originating from the U.S. trying to bail out an unwieldy number of banks with big deposits. So I wouldn't worry so much about getting a small bank deposit back, but I would worry about getting a big one back, and if it takes a long time for that to be processed. So probably you should use a couple of banks instead of just one, first of all. You should also keep some of your money in money market funds or in a brokerage account or something like that as a diversification, because they're at risk too, but they're not at risk for the same immediate things that local and regional banks are at risk of right now. And you should hold some cash. So diversify away from your bank without panicking or anything. If you've got an account that's less than $250,000, if your account is more than $250,000, maybe panic a little. Maybe get that money out of there today, put it in an account at Fidelity or Schwab or somebody like that. Take some cash, put it in a safe place at home, and maybe get a money market fund or a Treasury Direct fund or something like that. Just spread it around in accounts that aren't immediately threatened by what's going on right now. And pay attention, because the threat profile of the U.S. financial system is going to change over time. It could be the money market funds almost went bust back in 2009. They had to bail them out. So that could happen again. If you've got a Treasury bond account and the dollar really starts to tank, then you're in trouble there too. So pay attention. But right now, I think a little bit of diversification, but not panic, is warranted with what's going on with the small banks.
In most cases, it seems like diversification of, especially in this case, when it has to do with counterparty risk, is often a good thing, provided, again, as we mentioned, we can't give financial advice, but these are definitely valuable insights for our viewers here. I know last time we had you on, we were talking about gold and how and that's another option for people, obviously, to diversify. And a lot of people have been doing that. There's been this run on gold recently. The price has been elevated. And really, I remember last time we had you on, you said that, this time might be different than like 2008 when we saw the stock market crash and gold crash briefly as well, where we might just see a sustained elevated price for gold, and that being sustained, and it could go higher from here, even though we've seen this run already. And it seems like we've continued to see an elevated price for gold. Your perspective on that, is that still your view that we may not see a pullback from here?
Well, yeah, the dynamic so far has been, partially at least, people pulling money out of their bank accounts because they're worried, and partially at least buying some gold and silver with the proceeds. That could happen going forward in a much bigger way if more banks get into trouble and more depositors get worried. Because I think it's safe to say that, people don't pay attention to this stuff the way you and I do, Elijah. So there's a lot of people out there who really don't necessarily understand any of this yet. And they're living their lives and not paying too much attention to what's happening with their bank. Well, bigger headlines will bring more people into an understanding of what's happening, leading to them pulling money out, leading them to maybe buy more gold and silver coins. So that could be one dynamic going forward that helps precious metals. But the monetary conditions tightening thing that I talked about before is probably bad for precious metals. So that's the thing that would keep me from mortgaging the house and buying a bunch of silver right now. That we could have dramatically tighter money leading to a dramatic slowdown in the economy, leading to a bunch of different sectors blowing up, and a big crisis from that perspective, which might suck gold and silver down with it. So so far that hasn't happened. So far the dynamic has been positive for gold and silver, and it's possible that it continues, but don't bet the farm on that. By all means, diversify some of your cash into precious metals. You should have been doing that all along. You should definitely be doing it now via maybe dollar cost averaging or something like that, where you buy X amount of gold and or silver every month and just let it build up. You should totally be doing that. But dumping everything you've got and buying precious metals, that might end up being, a brilliant strategy. And there might be some people who become household names because they did that. But there's some risks associated with that. So I wouldn't advise people doing that right now. But always gold and silver are good things to own. And as we head into a period of crisis, it should absolutely be a diversification for people that have a lot of dollar cash or a lot of bond funds or anything that would be classed as a financial asset right now is at risk. So if you've got big giant money market fund, a huge bank account, bond funds in your IRA, you might want to lighten up on those things, and you might want to direct some of that money into precious metals.
I think that's very good. Again, diversification, I think, is key here. We do have a viewer's question that kind of ties back to what we were discussing at the beginning here. John wants to know, why do people continue to trust what the Fed says and does? So it seems like even though there's been this tremendous failure on the part of the experts, a lot of people still listen to them, especially in the financial world.
Yeah, amazing, isn't it? Because it's really been a 50-year experiment of governance by expert, and the results have been catastrophic. And the Fed is like the poster child for that. Everything they say eventually turns out to be wrong. And the current chair of the Fed right now is at least understandable and reasonably articulate. But Fed policy has been a disaster from day one, going all the way back to really the 1990s is when the real disaster started, when they bailed out everybody in sight and created something called the Greenspan put, which told the banks, go ahead and take as many risks as you want, reap the rewards of all those fees, and if it blows up on you, we'll bail you out. And it's been the same ever since. So the fact that somebody sees Jerome Powell on CNBC or someplace like that and listens to what he says and takes that as some version of the truth is astounding to me. I think it's a learning process. Like I said before, a lot of people don't pay the kind of attention that guys like us do. We kind of obsess over these things. Other people do their jobs, play with their kids, hang out with their friends, and don't spend a lot of time thinking about this. So it takes longer for new information to change their minds. But I think it's completely possible that we've got a critical mass of people out there who are all changing over all at once. And then the response to Fed actions and just government experts in general is going to be dramatically different than it has been in the past. This thing with public health was huge because a lot of people had learned not to trust the military-industrial complex and not to trust the big banks. But we still trusted the CDC. We still trusted our doctor. But then those guys did an awful lot of things that led to a lot of people losing trust in them. And for a lot of people, that was almost the last straw. It was like, okay, there are literally no experts I can trust anymore, and I've got to start changing my behavior to take care of myself without relying on these guys for their opinions and their advice. And as that spreads, as that critical mass grows, I think that it's completely possible that we just totally lose faith in all the experts. In other words, our trust horizon shrinks from very distant to local. In other words, we don't trust people that we can't shake hands with and look in their eyes and know their families and see what they've done in detail in the last 20 years. So we buy food from local farmers. We grow our own food. We start looking at food as medicine and supplementation instead of just taking whatever pill the doctor gives us. We educate ourselves about vaccines. And we don't give our kids 39 different vaccines by the time they're 4 years old. We research the ones that we think are most necessary, and we limit the vaccination of our kids to those handful of things that have been proven to work over time. And we don't trust the dollar anymore. We start loading up on real assets that the government can't inflate away, and that is farmland, which by the way, farmland is a good topic here to expand on a little bit, because lately the news has been coming out about the amount of farmland that the very rich are buying. Bill Gates is now the biggest private sector owner of farmland in, I think, the world. And then some billionaire just bought something like 5,000 acres in Wyoming for basically his doomsday bunker. That's where the guy's going to go if everything falls apart. So farmland and ranch land are suddenly very hot assets that are being bought up by the handful of people rich enough to buy huge amounts of those things. So if you have the chance to own something like that, food producing land, that's definitely a thing you want to buy. And the reason you want to buy it is because we cannot trust the experts who are in charge of our food system and our political system anymore. We want to be self-sufficient in as many ways as possible, and food is obviously the biggest one. So I think that's dawning on more and more people based on how in-demand homestead type land is now. And that's a big sign of a sea change in people's attitudes, that when it happens in one sector of the economy or the political system, it spreads to others, because once you lose trust in one set of guys with Yale educations wearing suits and talking to you on CNBC, you kind of lose faith in all of them. So this is coming, and the wave is building. And with your own money, you want to get in front of that wave and ride it, not oppose it and be smashed down by it.
Definitely. And if everyone would like to learn more about the financial side of all of this, they can go to your Substack, which we'll link in the description of this video here, rubino.substack.com, mentioning homesteading as well. I know my cousins are actually homesteaders in Minnesota. We recently interviewed them, and I'll put a link to their interviews in the description as well, if people are interested in just some insights on homesteading there. John, any last thoughts before we let you go? And did you want to tell us a bit about your Substack?
Yeah, the Substack newsletter I'm publishing now is focused on actionable stuff. In other words, we kind of mostly get that crazy times are coming. It's going to be very impactful on most people in a negative way. And what should we be doing about it? So, what should we be buying? What should we be selling? What should we be shorting? How do you make yourself invisible from all the people who are spying on you? Things like that. So you can sign up for free and see most of what I publish. And then some of the really deep dive actionable stuff is behind a paywall. And if you decide that it's worth it, you can sign up for that. But most of what I do is out there for free.
Fantastic. John, once again, thank you so much for your time, and God bless.
Thanks, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.